Hello, hello, hello. I am Nathan Garcia, and I want to bring you a quick recap of the stock market performance because I did a video this morning that you may have seen that discussed the futures market at the time being down about 800 points in the Dow. And it was pretty significant because it looked like the markets would open and they would sell off in a major way. And that's actually what happened. But what also happened is what you see here, where the markets didn't end up really selling off too bad. You see the Dow was down only about 80 points, so it made up about 720 points off its lows. So pretty significant round trip on the day. And then the NASDAQ actually ended up positive about 0.5%, and the S&P was down only about 4 points, down about 15 basis points there. So if you are, if you've been following me at all, then you know that if you've been following me at all, then you know that I pay attention to the markets and I try to help you understand exactly what's going on and give you a little bit more detail than you may find on Bloomberg or CNBC in the event that you don't have a direct line to the folks there, or maybe you just have some questions that you'd like answered. So today we saw pretty significant moves in the market, and if you looked at those charts closely, you notice that the buying really started once the European markets closed. Once the European markets closed, we saw that the most shorted stocks actually were bid. They started being bought, and as a result of that, you saw some of the Fang names, Facebook, Amazon, Netflix, and Google, all ended up positive. So here you can see that the Google ended up about 1.5%, whereas Amazon ended up about 1.85, almost 2%. You had Netflix up here about 2.74%. So some pretty significant moves there. So you might be asking yourself, what was it that caused that? How did we get to that point where we were able to make such a big move like that? And I think that there are really two things that happened. First off, you saw an article from the Wall Street Journal that came out and said that they don't believe that the Federal Reserve is going to have too many more rate hikes in 2019. And you also saw during the Treasury bill auction for 4-week Treasury bills, the interest rates on those were very close to the same rate that investors are being paid for 3-month bills that were auctioned off earlier this week. And the reason that's so significant is that investors are comfortable getting paid about the same rate of return, about 2.4%, for a month versus 3 months. Whereas if you thought that the Federal Reserve was going to raise interest rates in December or potentially early in 2019, then you'd probably want to get paid a premium, because remember, when interest rates rise, the bond yields fall, or the price of bonds fall. And so if you know that the Fed is going to raise rates, you probably want to get paid a little bit more today. And that wasn't the case. And so what that's signaling is that investors are, they don't think that the Federal Reserve is going to raise interest rates too much further. And that puts the Fed in a very interesting position. So the reason that I do these videos, and the reason that I think that this stuff is so significant for you, particularly if you're getting close to retirement, is that you shouldn't worry about the day-to-day fluctuations in the market. Really, you want to be concerned about the things that you are most concerning in your world. Hopefully, they're not your finances. And the way that you do that is really just doing two things. First thing you need is a financial plan, and your financial plan is just a model, a representation of your financial world that incorporates your income, investments, healthcare, Social Security, and your legacy plan. And effectively what it does is it models what your world could look like from now until the day you die. And when you have that financial plan, you can test if your retirement is going to be successful. And you can use different variables like what rate of return I get from my portfolio, how that will determine my success rate in retirement. And so if you need to increase it, you can. If you need to decrease it, you can. But ultimately, what you end up finding out is something called your personal family index. And that personal family index is the number that you should be using in your investment portfolio to have a successful financial plan. You see, the financial plan is going to guide your investment portfolio. A lot of people don't use their financial plan to guide their investment portfolio, and as a result, they take on too much investment risk. The reason that having too much risk in your portfolio is so significant is that if you have a year like 2018 where the market was up and then now it's pretty much flat, if you have to pull money out of your portfolio during a down year, then you may spend that portfolio a lot quicker than you would if the market was up. And so as a result of that, you want to make sure that you have an investment portfolio that's tailored to your personal family index and your financial plan. And when you do that, you don't care about what Trump tweets or what's going on with China or anything else, because you have a longer term view of things, because you know that the income that you have is more predictable and you have greater peace of mind about your financial future. So I hope that you found this video helpful, and if you did, give me a thumbs up or share it with somebody who you think would benefit from the information. But I look forward to seeing you in my next video. Thanks a lot.